Listen here, in this video, I'm going to talk about why inflation is so high. The cost of living is rising and it's only getting worse. Families are struggling to make ends meet and it's time for something to be done about it. The government needs to take action to get inflation under control. Otherwise, we're only going to see more and more families struggling to make ends meet. Thank you for watching. Why is inflation so high? According to Nigel Green, CEO of De Beer Group, the Federal Reserve should not abandon its policy of raising interest rates just yet, because US inflation cooled down more than was generally expected in October. Despite the fact that the era of steadily climbing inflation may be over, high prices will likely linger for a while longer. The Consumer Price Index reported by the Labor Department last month showed a 7.7% rise in prices over the previous 12 months, half a percentage point lower than the September figure. This signals that deflation might finally be on the horizon. Inflation still needs to rise to normal levels. CPI grew 0.4% month-over-month in October, matching the September increase. More than half of the monthly increase in prices was due to housing, gasoline, and food. The price at the pump increased by 4% in the last month, after dropping in the previous 3 months. The index, which excludes food and energy prices to provide a more stable measure of inflation, increased 0.3% in October, less than the increases in September and August. The October core CPI grew 6.3% over the previous 12 months, which was also a touch lower than the previous reading. The Federal Reserve can continue to be hawkish as long as core inflation remains high, especially as the labor market continues to perform well. This is because the Federal Reserve raised interest rates to a range of 3.75%, a significant change in a short time period following the inflation report. According to Nigel Green, CEO of De Beer Group, US inflation cooling down more in October than was generally expected was still too hot for the Federal Reserve to refrain from pursuing its policy of interest rate increases. CPI is made up of different components, and each tells a different story. Inflation in October, as measured by the Consumer Price Index, fell to its lowest level since January 2022, 4 months after it hit a 9.1% annual rate in June. That's the good news. The bad news is that September CPI inflation accelerated to 9%, the highest rate since January 2022, setting the stage for higher interest rates and higher inflation. Those purchasing automobiles may have foreseen the deceleration. The used car portion of the CPI, one of the first indicators signaling serious inflation in 2021, decreased 2.4% in October. Overall, used vehicle prices are up just 2% from this time last year. Drivers experienced unfortunate repercussions after OPEC Plus agreed to reduce crude oil production in October. Gasoline prices increased 4%, reversing the trend of falling prices earlier in the year. The price of other staples in an American budget increased as well. In October, the price of buying groceries and dining out increased 12% and 9%, respectively. The overall food index rose almost 11%. The core CPI is looking hotter than headline inflation. The reason why Fed officials and economists use core inflation to get a better read on price trends is because food and energy prices are really volatile, jumping around month to month, although they are vital to household budgets. The core CPI illustrates how enormous a challenge the Federal Reserve faces. Prices increased 0.3% last month and are 6.3% higher than last year. That's closer to the Fed's 2% target than it was last month, despite being down a bit. Economists and market experts alike have been anticipating home prices to tumble as mortgage rates soar to 20-year highs. Shelter costs rose 0.8% in the month and 6.9% over the last 12 months, continuing the upward trend. The CPI numbers came after some contradictory economic data. Wage growth was up 4.7% over the last year, but real earnings were down 2.8% over the same period. Employers added 261,000 jobs last month. The economy's gross domestic product dropped in the first 2 quarters of the year, signifying a recession, but it rose 2.6% in the third quarter. Forward-looking economic indicators, such as the Conference Board leading indicators and the stock market, have consistently performed poorly throughout the year. The 5.1% increase in the core personal consumption expenditures price index, one of the Federal Reserve's favorite inflation metrics, in October was higher than recent months and far above the Fed's 2% target. The Fed remains committed to fighting inflation, which remains enemy number one. The Federal Open Market Committee has made aggressive changes to U.S. monetary policy to bring inflation down to its long-term target of around 2% in 2022. Inflation has been the Fed's number one enemy. The Fed raised its target range for Fed funds by 75 basis points for the fourth straight meeting in November. Despite plummeting prices, the Fed will most likely raise rates by at least another 50 basis points when the FOMC meets again in December, because inflation has not diminished as much as it should have. According to the CME Group's FedWatch tool, market experts overwhelmingly expect the Fed to hike rates by 50 basis points. The current rate of between 4.25% and 4.50% is being priced as an 80% chance that the Federal Reserve will increase interest rates by 75 basis points. A 20% chance of a 100 basis points rate increase is being priced. According to Michael Landsberg, Chief Investment Officer at Punta Gorda, Florida-based Landsberg Bennett Private Wealth Management, investors should be more concerned with how rising interest rates into a slowing economy affect their portfolio values rather than the current level of inflation. Is inflation the catalyst for a recession? Raising interest rates aggressively to bring down inflation without triggering a U.S. recession is a difficult balancing act for the Fed. Companies and consumers are affected negatively by rising interest rates, which weigh on economic activity. The labor market in the U.S. has been solid so far, but the 21% year-to-date decline in the S&P 500 reflects concerns on Wall Street that the economy might not be able to handle spiking interest rates. Fund managers use discounted cash flow models to determine price targets for growth stocks, and these stocks are especially sensitive to rising interest rates. When the discounted rate is higher, future cash flows are considered less valuable. The Russell 1000 Growth Index is down 31% so far in 2022, while the Russell 1000 Value Index is down 11%. Of course, not every stock market sector is negatively affected by inflation. The Energy Select Sector SPDR Fund has returned 64% thus far in 2022 thanks to surging oil, natural gas, and other commodity prices. Market weakness has been widespread this year. Traders' animal spirits may be quashed by today's report. According to Samuel Fuller of Financial Markets Online, rates are cooling faster than expected in the United States, making a 0.75% rate rise next month extremely unlikely. The data provides the tantalizing promise of calmer waters where rate setters do not have to wreck economies in order to bring inflation under control. This, he says, will calm nerves on both sides of the Atlantic. What are you up to? Investors will keep an eye on the Fed's remarks about the economy at its upcoming meeting, which will take place on December 14th. On December 1st, the U.S. Bureau of Economic Analysis will publish the October PCE reading. CPI and PCE measure inflation by pricing a basket of goods. The CPI and PCE are calculated using different formulas, and the baskets are different. The CPI is based on a survey of goods consumers purchase, whereas the PCE is based on a survey of goods businesses sell. There is still a lot of data to digest before the next Fed meeting, so don't read too much into today's numbers. The goal of the Federal Reserve is to reduce inflation without hurting employment too much. This report shows that there is still a lot of work to be done.